Thank you, Paulo, but I'm not retired yet. So I'm still CEO till May of next year, and then I'll evolve to the chair role, so Franco-Nevada. And so thank you, Red Cloud, for this opportunity to speak here today. I was kind of wondering, because the conference is mostly for development and exploration companies. We're in a different stature now. We're an institutional grade company. We pay lots of dividends. Our investors are mostly institutional investors. So I thought I'd make it more relevant by really making my presentation a bit of a commercial for Franco-Nevada, but more in the context of that we are a source of capital for exploration and development projects. We like to have royalties on any good geology at whatever stage. And so I'm going to demonstrate to you why we can be a good partner in that front. I'd also like to talk about something else that's close to my heart and I think is relevant to all of us, is the gold price and what the World Gold Council is doing to make sure we have a robust gold market in the future, which I think is important for all of our projects. Now, because we're an institutional company, we have some big shareholders in London. I'm there every year to talk to our investors. And I had the privilege a couple of years ago of being invited to Buckingham Palace. And there was a possibility I might eat royalties, so I was coached. And they told me, well, if royalty comes to you, you can't address them, but if they come and address you, the first time you respond to them, you have to say, Your Royal Highness. And then subsequently, if it's a male member, you can say, Sir. And so there I was at Buckingham Palace, and Prince Philip, he's well in his 90s, he came up to me, and I was delighted. He put out his hand and shook my hand, and he says, What do you do? So I was prepared. I said, Your Royal Highness, I'm in the royalty business too. And I have gold royalties of mines all around the world. And sir, I'm really impressed by all the gold we have here at Buckingham Palace. And I wasn't expecting this because he's in his 90s. I thought this would be very curt, but he stepped back, his arms like this, and says, You can't have my gold. Now, I get that response from a lot of gold company executives when we're trying to do royalty deals. And I think that's actually the right attitude to have, because gold is something precious, it's rare, it has to be coveted. And so this is something we try to do at Franco, it's something we're trying to do with the World Gold Council. And so let me talk to you a bit about both of those. So first a bit about Franco-Nevada, a cautionary statement. But we call ourselves, the ticker is FNV, we call ourselves the gold investment that works. And as you notice, I think we delivered. We've outperformed the other gold companies, we've outperformed the gold index itself. It's something that we've done since our IPO for the new Franco-Nevada, which was almost 13 years ago, December 2007, that we went public at $15.20 a share. But what's more important, if you're an institutional investor, is a gold investment competitive? And I think what we're trying to do now is any investor looking at our company, we're saying, you don't have to depend on the gold price. You don't have to depend on us performing relative to other gold companies. We've been an outright good investment, irrespective of where you're looking to invest. We beat NASDAQ, S&P 500, the Toronto Stock Exchange, gold bullion itself, that this has been a compelling investment whichever way you go. And how does this work? How can you be outperforming in these categories relative to other indices? And I think it's a reflection of both our business principles and our model. And the key thing we have is we're not a mining company. We've created a company that we don't operate mines, we don't explore or run drilling rigs ourselves. Instead, over 30 years now, we've been collecting royalties on good geology. And so when I describe our company, because you go to meetings in New York, the easiest way for investors to understand this in New York is we're the Airbnb of the gold mining industry. Because we don't run mines ourselves, we're essentially getting a little piece of lots of mines around the world, and that's the Airbnb business concept. They get that right away. We want to maximize the good stuff of the industry. We want to minimize the challenges of the industry. And so royalties has been the perfect instrument for us to participate in the industry. And where we demonstrate our business model is to say, look at these areas. There's different ways to invest in gold. There's advantages with the GLD or gold ETFs, but there's disadvantages too. They cost you money. There's no alpha to gold or beta to gold. There's no yield that comes from them. Relative to gold mining companies, we have we can share the upside. We have the optionality for new discoveries and expansions. but we don't have to share mining capital costs or operating costs. And so I think when the investors are looking at it, they see us as a third option. There's operators, there's bullion or ETFs, and there's a Franco-Nevada that can give you something of a blended type of combination of investment returns. In terms of the company, it's obviously resonated with investors. We have a market cap now that is just behind that of Barrick's and Newmont's in terms of gold companies around the world. The other important aspect of running an Airbnb is you just can't have 1 or 2 rooms for rent. You have to cover a broad range of assets and have a very diversified portfolio. And that's what we have in our asset right now. We just announced 2 more royalties that we added to our royalty package just this week, so this is a lot of date. So we're now about 372 royalties around the world. And I think what we've done is we've really, it's almost a representation of the entire industry. We have not only producing mines, but we have a whole slew of development projects, and we have exploration projects. So we need that pipeline to have a long duration in the portfolio, and all these things are bought and paid for, so we don't have to put more capital into them. We can reap the benefits of anything that develops on the properties going forward. One of the advantages too with royalties is we can do it with relatively few people. It's an easy business to administer. Our company now counts 34 people worldwide. And when you look at it, we can manage this with relatively flat G&A. So you can see on a quarterly basis, our G&A has been flat for the last decade, even though our revenues are quintupled. And we expect actually revenues to decline by another 50% over the next 5 years. I think we might add 2 more employees, but I think that G&A number should stay relatively flat. So it's an absolute scalable business, relatively few headaches. We've worked with a lot of counterparties, but in my 32, 33 years of doing this business, we've never had a legal issue in terms of lawsuit with any of our operators or counterparties. So I think we've been a good partner as well with the community. I'm told we have the highest market cap per employee. I think it's about Canadian $70 million per employee for our company. And the other important thing is to have a long duration in your portfolio. Some of our investors look at us as a gold-backed bond. They like the yield, they like the fact that it has that gold relationship to it. And why we can have a long duration is we're not limited to the gold industry itself. If you look at a typical gold mine, maybe it's 15 or 20 years in terms of the life that they're designing things. When you go to the base mining industry, then they're developing mines with a 30 to 50 year time horizon, and there's good potential to extend even beyond that. We've been able now to buy gold from these long life copper assets around the world. And so one of the big advantages is we have now very long duration assets in our portfolio that's going to generate revenues for us for the next 30 to 50 years. And these are also these are proven franchises that are run by some of the best operators in the world. First Quantum, BHP, Glencore, Teck, Lundin. And so we're very comfortable in terms of the quality of these assets and the people behind it. Cobre Panama, of course, is going to be our new driver over the next few years. It started shipping its first concentrates just in June. We got our first gold deliveries just in July, so it hasn't yet hit our revenue statements. So as that mine is ramping up, you'll be seeing the first benefits of it in the current quarter, Q3 of 2019. You'll see that ramp up in our revenues, and that's why I'm very confident we can provide guidance that we're one of the strongest growth stories in the gold industry over the next few years. And then in terms of the financial numbers, always important for the institutional investors. What you've seen is good growth across the past 11 full years that we've reported. 2019 was a bit of a down dip. One of our major assets, Candelaria, had a pit slide, which held back. They had to produce from stockpiles, which were lower grade. And but now it's ramping back up again, so that's another aspect of. We've had a good, strong first half, and we've been guiding the street to expect record numbers in our second half of this year and going forward. So we think we're now beginning to pump on all cylinders. I also like to point out the bottom left chart, the G&A. We like to do show the G&A relative to our market cap. And why we think that's important is a lot of investors say, "Oh, we don't like the G&A of operating companies. The executives are paying themselves too much, etc." What we're pointing out is that the biggest ETF in the gold business is a GLD that trades in New York. It charges investors 40 basis points on the value of the gold that it holds. Well, we're running this company for about 16 basis points relative to the value of the assets that we hold. So I like to brag that we're twice as efficient as a gold ETF in terms of delivering gold optionality to our investors. And in terms of the ultimate test is, can you pay dividends? And one of the things now is we've now been progressive. We've paid 12 consecutive years of paying increased dividends. We've now paid almost $1.2 billion in dividends. Well, that was the value of our IPO 12 years ago. Now we've paid back the money from our IPO 12 years ago, and we've been paying an increased dividend. That's about $180 million a year. It's one of the largest absolute payouts. Now, the big pushback I get, sometimes people are saying, oh, your yield is only 1.4%. Why aren't you paying more? Well, that's because our stock price keeps going up. And so my argument is total return is what that matters. We'll keep raising our dividend as our assets continue to grow. But what we're trying to do is make that as an absolutely defensible dividend. We don't want to ever cut our dividend because we're now held in a lot of dividend funds. We're part of the Aristocrat Index, which are companies that deliver continued dividend increases, and we believe we can maintain this track record indefinitely in terms of our outlooks. And one of the other nice things about this is, because I mentioned the business is so easy to run, that if our entire management team, and actually my management team doesn't like that when I say this, but because some of them are in the room right now, but if the entire team got hit by a bus, we can continue to pay our dividends for the next 35 years with no cuts, and we'll have billions of dollars left over in the treasury. So this is why, when management comes for a big pay raise, we say, that's all right, we can run it without you. So it's that's how we're managing our G&A here. So it's working really well and very defensible, robust business. So when people are looking for a defensive investment in the gold business, they can look at Franco-Nevada as one of those opportunities. Then another thing is organic growth. I showed you the big mines, but we've got all these other mines that are coming into production or expanding in the next few years. Tasiast just last week with Kinross just announced the next phase of expansion of that mine. We'll get that for free. You just heard in this room from Pretium with their Brucejack mine, which is ramping up beautifully. We have a 1.2% royalty on that asset. We have also exploration royalties that we've been investing in, and actually I think at this conference here is Marathon Gold. Matt Manson, I was just talking prior to this conference. We invested in that project to help them advance their exploration and their feasibility of that project in Newfoundland. We think Valentine Lake is one of the real up-and-coming projects in the world. So even at an exploration stage, we're willing to put in capital because we believe in the geology and the upside, and it's something we're going to hold forever. And in fact, to show you how excited we were, even though we didn't have to, they were doing an equity issue just a couple of weeks ago, and we put in the lead order as our endorsement of that project. So we're very proud of it. We've also done Solaris Norte is another royalty. It's at the pre-feasibility stage in Latin America. We think that's another up-and-coming project, so that's part of our pipeline going forward. And we've also been doing oil and gas investments in the U.S. We love the secure title that you have for royalties in the U.S., and we find that's a good area to grow. So putting it together, all the assets that we have, as I mentioned, we have great growth on the gold side because Cobre Panama's ramping up right now. Candelaria is getting back to normal operations. Our U.S. oil and gas energy investments, we've just invested $1.2 billion in buying into Texas and Oklahoma. We're very excited about it in terms of the potential of what these assets could do over many decades, and we think it's a great environment to be investing. But that's going to translate to over 50% EBITDA growth for our company. Again, if we do nothing else in this company, we don't buy another thing, that's going to come just from the portfolio that we have today. Now remember, these are forward-looking statements. You read that comment at the beginning. So, I think those ingredients is what produces track record. I think we are proud to continue to say, we expect to continue to say that Franco-Nevada is the gold investment that works. There's about $140 billion worldwide right now in gold ETFs, which is passive gold sitting in safes. And so my challenge right now is to get out to all those people that own the GLD or other gold ETFs saying, why do you own that when you could be owning this instead? You can get the leverage as people keep finding more gold in our properties, and we can pay you that dividend over time rather than charging you money just to be exposed to gold. And so that's why I think this is something that shows the strength of our company. I think it shows that we've got the strength to invest in your projects, that we can take a very patient view on both exploration and development projects, and be a partner at multiple stages of your financing, either at exploration, development, or equity financing stages. And we tend to buy and hold. We regard every one of our royalties as our baby, and we never want to give it up because it's a free option with no carrying costs. So that's enough on the advertisement for the Franco-Nevada. And I want to talk to you about the other important thing that's important for a lot of us in the room, and that's making sure we have a robust gold price. And I have my hat as well here as the chair of the World Gold Council. And it's an organization financed by the leading gold companies of the world to try to make sure that gold has a strong market, and that we stimulate the market demand for gold and hopefully the price as well. Now, one of the things about my frustration is most mining company CEOs spend more time marketing their shares and equity than they do the gold price. And you think about it, that it's the ultimate commodity. If almost every other industry, the number one focus is marketing your primary element and then selling what a good business you are and selling what the equity is. And one of the scary things is that in gold mining, we actually produce more gold than is actually physically consumed in the jewelry business, about twice as much. And the only way that works is we have to convince central banks and investment people to buy more and more gold and to hold on to it. And so right now, we have about $4 trillion of gold in the world, outside of jewelry, that are sitting in wafer form, in bar form, or in coin form. So highly liquid gold. And each year we're adding to that pile. And so one of the things I've been talking to our fellow mining CEOs is we can't ignore that pile. We got to make sure there's a strong argument for people to continue to add to their investment holdings of gold. And that if, as a mining CEO, I've tried to make it actually quite personal, that one of the biggest risks in mining is that tailings impoundment wall to hold back the tailings. Well, we have an impoundment wall we need to manage as well, and that's holding back all the investable gold that's out there, $4 trillion worth, and making sure that we can add to that in the future if we want to continue as a gold mining industry. And if it ever started leaking, $4 trillion worth represents about 40 years worth of supply for the jewelry sector. So if you think about it, this could be the lowest source of gold. It could put all gold mining companies out of business as the jewelry industry is sourcing their gold from the existing stockpiles from investors. So we have to make sure there's a really strong argument for investors that will go. Well, hopefully, happily, there's a few positive things that are being done on that front. And one of the best things is what the World Gold Council has been doing with central banks. And just to show you how serious this investment case for gold is, if you look back 30 years ago, $1.5 trillion worth of gold was held by the central banks, and they were sellers. And 20 years ago, Gordon Brown, for the Bank of England, he made the pronouncement that the British Treasury was going to sell all its gold, which just encouraged all the other central banks to start dumping their gold. This was about 1998, 1999. And so it was causing a run in terms of gold selling. And there's a couple of things that helped slow down that run. Is one, the World Gold Council actually got all these countries together saying, it's insane, if you all sell together, you're going to destroy the gold price, you're all going to be poor as a result. So they were able to get a central bank accord signed that actually created some limitations that the banks could only sell up to 400 tons of gold a year. That helped to slow down the rest. Then the other thing is, what turned the central banks back into being buyers of gold again? Well, ironically, the gold mining industry is the biggest beneficiary of the global financial crisis. So in 2008, when we had the big financial scare, that's when central banks started buying again. And I think what they needed to do, though, was have an understanding of gold and have a proper view that this was something that's going to be acceptable as a central bank reserve asset in the future, because it's no longer linked to the dollar as it used to be in the past. Well, I think the World Gold Council has been doing a fabulous job on that front, because what they've been doing for the last 10 years is running schools for central bankers where we have them at Cambridge, or at Harvard, or at the schools in Singapore, or Beijing, which is going to be in the next month. And what we do is we get 30 or 40 central bankers together. And they say, oh, geez, it's interesting. The Bank of Poland is here, the Bank of Argentina, or the Bank of Italy. And they're all interested here, and they want to learn about how to account for gold, how to trade gold, how to do safekeeping of gold, and the arguments of why gold is a good reserve asset within their portfolios. And so it's been so effective that the banks awarded the World Gold Council their Central Banking Award for a good advisor to the banks in the last year. They see us as a credible counterparty. They're educated in terms of what a great asset that gold can be in their portfolios. And I think we're getting the benefits. The first half of this year, we saw more central bank gold buying than we've had in 30 years. And I think what we're doing now is we're helping to stimulate this de-dollarizing trend in the world, where people are now central banks are saying, well, geez, we don't want to hold too many US dollars. We're not ready to hold RMB yet. We're not ready to we're worried about the euro. Well, gold might be that diversifying asset. And I think the central bank has given that authenticity going forward to make gold positive. And when you think about it, from where we were, where we had 400 tons of selling back 20 years ago, to where we have now 600 tons a year of buying, that's 1,000-ton swing in supply-demand for gold. That's a quarter of the market for gold, 25%, just on this one factor by itself. And so right now, the World Gold Council, I went to visit their London offices a couple months ago. The lady that was running this was going crazy because there's 182 central banks in the world. 150 of them want to work with the central bank to understand gold and what to do. So we're very optimistic. There's more gold buying coming from the central banks, and I think the World Gold Council is doing a great job of making sure that it happens. In terms of the other, as I mentioned, of the $4 trillion out there, there's $1.5 trillion central banks, but there's $2.5 trillion in other hands. And so institutional hands, retail hands, private family offices, etc. And so what do the institutions think about gold right now in terms of an asset? Well, it's awful. This is a survey of pension funds, and gold is the last thing they're thinking about in terms of investment assets. So, and there's a number of reasons I'm going to get to, but it means there's a lot of work we need to do in making sure that the $2.5 trillion gold that's already held by institutions is not only held strongly, but we actually create more of an appetite. And it is a big opportunity. There's only 1% of those sort of institutional dollars right now are invested in gold. And yet, when we have our own econometric models, etc., we've tested most of the endowment funds and pension funds out there, and we're saying actually the optimal level of gold in your portfolio, because it has a negative correlation to other assets, is probably about 4%. So if we could get the institutions just to get to the 4% level, that's $6 trillion worth of gold. That's more than all the investable gold that we have out there. So the only way then to solve the equation is get a higher gold price. So that's our dream. We got to do a better job of selling financial institutions on why they should be holding gold, because we can't always rely on the central banks. And so this is the effort going on, and that's why the World Gold Council produces a lot of things to make it more easy for them. And when institutions are asked about gold, they say, why don't you own gold? And what they get is that they don't believe they have enough information about the gold market. They don't believe they understand the gold market. And so what we've been doing now is we've invested probably over $100 million in the World Gold Council to put together the best data series, to put together the best econometric models that investors can use to test their portfolios against different weightings of gold in their portfolio, that they can put in their own macro scenarios for the world, what they think is going to happen to the markets or interest rates, or in terms of the growth of the economies in Japan, in India or China, and then they can make the derivatives. But we're trying to give them the tools to make that going forward. And so it's one of the most key things for our institutional investors, and it's a big focus. And I think you often see these studies coming out of the World Gold Council in terms of supply and demand. We have a quarterly report, what's happening. That's just one piece of the equation. The Gold Hub is where we can go on the gold.org, our website for the World Gold Council, and you can get almost every relevant data series attributable to gold demand around the world, either physical or investment case by geography, and you don't have to pay Bloomberg for it. We've already paid bought it, and we have the rights to sell it on or provide it to you for free. So you can do your own research as a potential institutional investor or a retail investor to say, does gold make sense? And let's just do some real science and real research in terms of what it does for our portfolio so we can present it to our investment committee. So those are the tools that we as an industry are providing the institutional investment industry to help things happen. So the Gold Hub, Gold Valuation Framework, Gold Demand Trends, all these for free on gold.org. So knock yourself out, help yourself to know what that resource is. And the other thing is you have to make it easier to buy and trade gold. And the World Gold Council invented the gold ETF back in 2004. We created the GLD, which was the runaway success. And today it's got about $44 billion worth of gold in that ETF. And so it's been a wonderful thing for institutions in the US especially to make it easy for them to buy gold. Because when you think about it, gold is actually kind of a boutique-y thing to buy. You know, in the Western world, you've got like 3 nines with carats and bars measured in troy ounces. Well, other parts of the world, like in Asia, they do it in grams, but it's 4-9 gold and in metric wafers. And so you got different purities, you got different products. It's not a 24/7 market around the world, and it trades on different exchanges. Some of them are behind currency restrictions, such as the Shanghai Gold Exchange, or they're in London, but they're now being subject to new trading restrictions and liquidity constraints because of the LIBOR scandals and the FX scandals. All these things have to be reviewed on the gold trading in London as well. So the GLD made it easy for American investors, but the trouble is the GLD is mostly traded by hedge funds. They're making macro bets, they're in and out, so they don't care about the fee they're paying, they just want the tightest buy-sell spread. So last year we created another product called the GLD Mini. We charge only 18 basis points for this product. Why do we do that? Is because TD Ameritrade provides, and Schwab and State Street, they provide these platforms in the US that allow retirees or employees at companies to form their own retirement accounts. And in those retirement accounts, they can say, oh, I want 60% equities. I want 30% fixed income. I want 5% bonds. And now they have a choice. They can say, I want 5 or 10% of gold. And what TD Ameritrade or Schwab would do is they just put them into that ETF that works. And they want to charge 7 basis points for this thing, and they don't want anything to be more than 25 basis points in total. So that's why we charge 18 basis points, so that we can be an overall 25 basis point cost to these retirees that are owning Roths or 401k accounts in the US. We just started this last fall. We're over $1 billion in this account with no marketing. And this is sticky gold. No one has sold this gold, because it's all people that won't retire yet for 5 or 10 or 20 years out. So they're putting gold in their portfolios, and this is going to be permanent gold versus the hedge fund trading that we get in the current March ETFs. So I think this is a great initiative. I think we're going to be doing more of this around the world, because I think this is the future, is platform investing, and we want gold to be part of that platform and be seen as right up there with real estate and with equities and bonds as something that all investors can consider as part of their portfolio. The other thing we're active in is the new trading platforms. We're going to partner with the Shanghai Gold Exchange. Wonderful expansions. It's been an effective market. It's going to be someday the dominant physical market for gold in the future. But because there is not free trade on the RMB, currency exchange, it's still somewhat limited to the Asian market. In the London market, there's challenges because we just had JP Morgan. There's been this fraud accusations and how they've been manipulating the gold price. And so, there's been attempts to get this LME Precious, which is more of a clearing exchange versus an over-the-counter exchange for trading gold. So we're still trying to build that up. But right now, the Bank of England is going through a review of the commodities markets. And so you're going to see within the next 2 years, it's going to be a fairly significant change in how gold is being traded in even the London market, which is still the largest physical market. The World Gold Council is playing a very major role in terms of trying to get these new rules in place to make it a more transparent and open market, but a market that everybody can have confidence in. In terms of the physical demand, I think most of you know, it's gone from west to east. It was interesting when you look at when the World Gold Council was formed. You know, we formed it back in 1987, 32 years ago. And what was the focus? It was to make gold more transparent by providing a lot of free research on the gold market and supply and demand. And the other ones is we're really going to work hard on marketing gold in our biggest markets, which is North America and Europe. Well, they hardly matter anymore in terms of physical demand. And the physical demand has moved 15 years ago to China, to India, and those are dominating the market right now. And what we have now is relatively small physical markets in North America and Europe. And that's why you don't see a lot of the World Gold Council here, is that we're trying to spend our I guess, policy and physical market efforts in the markets that are growing the fastest and have the best demographics, and that's in the Asian markets. And so, you know, I get the issues is, what is the World Gold Council really doing? If you're sitting in Mumbai or in Beijing, you'd see a lot of the World Gold Council's presence. It's just, those are the markets that are really relevant to us right now. And in terms of the policy efforts, people don't realize how much sales work and effort has to be done to sell governments on making sure that they own gold. We opened our office in Beijing in 1994, and we spent 10 years providing policy advice to the Chinese government. And it took, in 2004, that's when they made the crucial decision, instead of regulating gold as if it was some sort of commodity, as it is basically regulated in the US, they decided gold should be a financial asset, and they wanted to create the regulatory framework that it's easy for anyone to buy gold in any branch around China, and they want to create a regulatory framework where even their institutions could buy gold, their pension funds, their insurance companies, and they want to create a regulatory environment that's friendly to fintech, because a lot of people aren't quite sure where is the gold if you're buying gold on an app. Well, in China there is WeGold, sponsored by WeChat. And anyone can buy gold now, but they have complete confidence that the gold is at the anti-gold exchange because it's monitored by the Chinese government. So one of the things is a lot of people want to have complete anonymity and not have anyone know where the gold is, but it comes with a risk. How do you find it? Or if there's a fraud, etc. In China, they've eliminated all that risk, but there is visibility for the government, but that's why they're comfortable in investors investing in gold, because they know what they're investing in and they know where they're going to store. The irony is, you go to New York, and if you want to buy gold, you can't go to a bank branch because it's regulated as a commodity, so bank branches are financial institutions, they can't be commodities. So where do you buy gold? You have to go to the pawn shops in the Diamond District. It's insane. And go to India, in China, you can go to any rural branch of the ICBC, which is the largest bank of the world, and you can buy a wafer. It'll be in metric terms, you can't buy in ounce terms, but you could buy grams and wafers of gold at that bank branch, and it's easy and it's credible because you're buying it from a real institution. So these are challenges that I have, is that I'm looking at the regulations for the world, and the most balkanized regulations we have are in the Western world for gold, and we have to work a lot harder to try to get better regulations and get gold treated as a highly liquid asset. In terms of other policy wins, the other thing the World Gold Council did is we were going to these conferences, and you know, it was actually the light dropped on us. We were at a conference in Dubai, and we were making the case for gold, and a cleric stood up and he says, "Well, it's not Sharia compliant. You know, nowhere in the Quran can we say you're allowed to buy gold." And we said, holy cow, there's so many Arab firms that own gold already, but right now we're being challenged. Is it Sharia compliant? So the World Gold Council funded the best auditors in this Islamic world, the best clerics to form an association to put up what are the rules for making gold Sharia compliant. And it's a bit different. What they're saying is you have to have 1 day settlement instead of 2 or 3 day settlement as we do in the Western world. But if you do simple things like that, have a 1 day settlement, it's Sharia compliant. And so now we have a whole bunch of new ETFs and actually gold physical funds being formed in the Islamic world that now are being challenged on whether it's Sharia compliant. And so I guess this is another policy win. The other one is just going around the world and saying, where do they tax gold the most? In Russia, at the beginning of this year, they had an 18% VAT on anyone buying gold, or GST. And they are now changing that. And that's from some quiet lobbying by the World Gold Council in the background. They just made the announcement about a month ago, it's not yet, but we believe the Russians say we'd rather have our citizens owning gold rather than US dollars. And so I think it's actually been a fortuitous time to be there and give them the right arguments in terms of why they should be buying gold. And then in terms of the other aspect of the World Gold Council, it helps the industry speak with one voice. Instead of us all being isolated companies trying to make our own case for the commodity, we have one organization that's trying to make, have 26 leading gold companies in the world sing from the same song sheet. And we've done a number of things. We came out 5 years ago. I know a lot of people don't like it, but the all-in sustaining costs. Remember, we used to have cash costs and total cash costs. And we came to all-in sustaining costs and total costs. It's a new standard. Some people like it, don't like it, but at least we got to write the rules ourselves rather than being forced on by other people. Also, when the Helms-Burton law was coming in terms of conflict gold, we wrote the conflict gold standards for the gold industry, because otherwise there was going to be a bunch of people from NGOs in New York that were going to write them for us. And now we've come out just 2 weeks ago with the new ESG standards for the world gold mining industry, and that's the responsible gold mining principles. And this is something that we announced in New York, and then we 26 companies rolled it out in their presentations at the Denver Gold Show. There's 52 principles involved in terms of both environmental, social, and governance that the gold companies are going to adhere to and have a third-party audit done on their companies. So this is something we're very, very proud of, that we could speak in unison, and every company on the World Gold Council signed on. And the interesting thing is we have principles. And I was at this conference and the head of State Street ESG was there. And they were saying, oh, we need even more principles from the company. We're going to add more things and put the demands on. And I'm saying, well, geez, ESG firms, what are your principles? Will you commit, if there's any company that's making a takeover offer, and that company has a lower ESG standard, surely your principle should be you'll never tender to a company with a lower ESG standard. Well, that was like showing the crucifix to the devil. You know, it was just, oh, we have fiduciary duty to our investors. The ESG firms have no principles. They're downloading all these costs out of the mining companies. They're trying to have a moral high ground, and yet they don't have a principle that they can stand on themselves. So I think one of the things we're going to do as an industry is actually push the ESG industry that's out there to have some principles of their own. So it's something that I think we're feeling very passionate about. We feel we have the moral stature in terms of our 52 principles, and we're going to push back on it. So over time, we've done a lot of things. ESG is, the World Gold Council's moved from an organization that was Western physical, jewelry demand-oriented research to doing a lot more things. And I think the big opportunity for us is making sure we can drive investment demand. I can tell you we're getting a lot of meetings right now because people are all of a sudden interested that have never held gold before. And I think we're improving our effort in terms of making sure that we can build that tailings impoundment for all that liquid gold many times higher so we can get the gold price even higher in the future. And so in terms of attributes of the World Gold Council, lots of things we're doing. I'm happy to have been able to do this advertisement. When you see gold mining companies that actually are paying their dues to be part of the World Gold Council, thank them. These are the leading gold companies in the world that are trying to do something to advance their industry. I think we're being proactive right now, and I'm very proud of what we're doing. So that's my story. I think I used up all my time, Paulo, but
no, I think we should still open the floor up to a couple of questions here. I don't know if anybody has any questions for David. We've got one here. Can you I'll come over with the mic. That's right, I've already lost you. Where were you?
There's a lot of good things that you're doing. I commend you. However, at 10 o'clock in the morning, JP Morgan can flip the switch and short a ton of it. They'll cover in the afternoon after they've triggered all the stops.
Yep.
How do you fight that? This is paper gold. It's not even the real thing. And they seem to be able to control it for years and years and years. But
that's exactly the problem. And I think everyone, if you had Sprott here this morning, you have John Hathaway, they have a strong passion that the gold market has been manipulated for a long time. And the reality is the gold market has been trading as a club. When you had something called the fix in London, well, you know, that's just absolutely the wrong language to have for the gold price. And it only could be done by bullion banks, where there was a lot of restrictions for you to get in and actually trade physical gold. And this is what's going to have to happen, is the Shanghai Gold Exchange right now is set up so any financial institution can come in and trade gold. Go to the London market. No, you got to have all these prerequisites before you can come in, so it's not an open market. The Bank of England, with its new Financial Market Standards Board, which is just starting right now, they've done the LIBOR market, they've done the gilts, they've done the FX market, they're about to reorganize the bullion market. So I think you're going to end up not having bullion bankers in the future. You're going to have just regular financial institutions, but a lot more of them, because we can't leave it to a full bullion bankers. It's dominated by JP Morgan, HSBC, and it's been subject to issues in the past. The only way to do it is we've got to have an open exchange with clear settlements where you can see the forwards, and also link the physical market to the paper market. There is no linkage right now. When they set that gold price in London, it has no reference whatsoever to the paper market. And this is crazy. Those markets should be feeding off each other and settling between themselves and arbing off each other. And right now you've got these sort of big gaps where they're not being arbed between all the time. And I think that's what's going to happen, is we're going to be restructuring this. It's going to be painful. I think the gold companies are going to find there's going to be a little less liquidity from the bullion bankers in the next 2 years, but then there's going to be a lot more liquidity. So it might happen that the gold companies will have to be involved a little more in marketing their gold. Actually, the old days we used to own our own gold refineries. Maybe we'll be back in that business as well. But we'll get to know our customers, and then once we have a real marketplace, we'll be able to deliver. So we're trying to fix that issue right now. It's very top of mind.
Thank you for that, David. We probably have time for one question, and since I've got the mic, I'm going to ask the question. Since Brown's bottom, have you seen a change in the tone of central bank discussion, especially in light of the large proponent of world bond market trading with negative yield?
These central banks aren't in it for return or yield. They're looking for a store of value and flexibility and liquidity. And so I don't think the negative issue on yields has impacted the banks at all. What they're scared about is the US dollar and tail risk in the marketplace. And they all want to diversify from the US dollar. And I think what Trump has been doing has been our best World Gold Council member, advocate. He's scared enough people saying, we got to diversify from the US dollar. That's why Russia has been the leading proponent to get out of it. And it used to be just the bad guys. It was Uzbekistan, Tajikistan, and all these. But now you're getting Poland, you're getting more Western countries saying, oh, we better have a little more gold and build up that side of it. China only last year resumed the buying of gold after being in a hiatus for about 3 or 4 years. So I think what it is that de-dollarizing impact more than the negative interest on that. But for investors, absolutely institutional investors are looking and saying, okay, now there's not a carrying cost for not having a yield of gold. And we can look at it on a total return basis. If our other investments are yielding negative, gold doesn't look so bad. So for central bankers, absolutely not. But that's why we're getting so much more interest out of investors. And that's why we're really trying to build up the number of meetings we're having in front of investors to make that case for gold. We don't care whether they buy the ETF or gold royalty companies or physical gold. We'll let that decision be theirs. We're just saying you got to have some form of gold in your portfolio.
Thank you, David, very much for your time.